Okay, welcome everybody to today's session. Today we have Parmesan on a short note taking over this meeting as a host, and on the other side we have Tim Niemeier. But before the two get started and really talk about how to build, VC-proof tech, let me just give you a very brief intro on why we are here in first place, and then I'm happy to hand it over to our host and guest today. So, all together. Oh, this was one too far. What is DueDash all about? Who is hosting that series here of startup lounges as well as investor lounges once a month? So DueDash is a game-changing startup investor hub that really covers the entire value chain of a startup investor relationship with data points as well as interactions. So for you as a founder, you can do everything from finding new investors, sharing all your data securely with the investors, keeping them engaged via messaging and updates, up to really managing all your engagements in one place. And altogether with DueDash, you can save up to 40% of your time so that you have less time spent on fundraising and more time on company building, which ultimately can also end up in building great tech, as Tim is going to talk about today. So creating a profile on our DueDash investor relations platform, by the way, is free of charge. So it's no pain, just gain for you. We will touch base on some of those aspects in a bit. I will share the link with you also in the chat. Apart from that, for the ones of you that are new to fundraising or need to refresh the approach because you're just realizing it's not working out the way that you're approaching investors, we have an interactive Dash to Investability course that really helps you understand how to build a business that can raise funding in first place, and then on the other hand, how to handle all those investor curveball questions that are getting thrown to you or at you throughout the due diligence process. Also on our education platform, you can find free templates and resources here under the link that we've shared. And last but not least, we've also built a great set of global strategic partners and others that provide partially exclusive discounts and credits to our DueDash community. So every startup on DueDash Investor Relations platform that has more than 70% of profile completeness is eligible for up to 100,000 in credits, among others, now also with the Rock deal. So happy to share this in a bit as well. And with that being said, if you have any further questions or you're interested in a partnership with us, please reach out to my colleague Michael. And with that, I'm already handing it over now to Parul and Tim here. Let me just stop the screen share and get you up front here.
Thank you, Marcus. For those of you who don't know me, I'm founder and CEO of DueDash. I'm also an investor. And basically, the DueDash investor relations platform helps startups save time, which Marcus just mentioned. And this was a journey that I came to as building different businesses, also investing in private companies for more than 15 years. I have built businesses for multi-million dollars in the past, have experience in M&A and basically the entire shebang. And I'm excited here today to welcome our guest, Tim Niemeier. Tim, in his last job, was a CTO at Rocket Internet and Global Founders Capital. And now he has found Rock together with Fabian. They have a long history of working together for more than a decade. And he has also launched a couple of tech startups in Berlin, and he is also freelancing CTO, delivering large-scale IT innovation projects for startups and enterprises such as Bosch, Metro, and other companies. So Tim, I'll hand it over to you now to talk a little bit about yourself, share with our audience who you are, what led up to you to come to Rock today, and just share some insights about your journey.
Cool. Yeah, with pleasure. Thank you for having me tonight. It's really cool to be here. Thank you also all for tuning in. I'm really excited for this opportunity. So about me, I studied business and economics and finished and graduated that in 2010. I worked also in the business area at the big corporate Bertelsmann here in Germany for a couple of months before joining Rocket Internet back in 2011. Rocket was really small back then. It was just like a couple of dozens people, not much more. And I had a natural passion for tech, I would say. And basically, I got aligned that what I studied is actually not the passion I want to pursue in the future. So with Rocket, I got my hands dirty in tech. I launched e-commerce ventures around the globe, from Brazil and Europe, Middle East, Asia, and also in Australia. I was actually also in Australia on the ground for a few months to roll out the fashion shoe business over there. What in these countries here would be Zalando, is the iconic in Australia and New Zealand. So helped building that up. Then joined Project A Ventures right from the start, built up 2 ventures under the umbrella. The first one was Tyrendo. Again, I was running tech and product there. The second one then was MyNotes, which is an offline analytics startup. I was very, very lucky. Both of them have exited along the journey. And as you said, I mean, yeah, then freelanced quite a bit, got more impressions, and finally could join Rocket Internet Global Founders Capital. It was a really cool challenge also before founding Rock together with my friend and former colleague Fabian Wesner. He founded Spryker beforehand. Spryker is one of the big e-commerce vendors from Germany, a rising star, also part of the Gartner Magic Quadrant. And yeah, I really like working together with him. So we are probably one of the few startups in Germany and the world which is well equipped with CDOs, because we have 2 of them, and no business founder. So I take over the business part, and the real deep tech is up to Fabian to deliver our solution in that regard.
Awesome. So this is an amazing journey and a very impressive journey with you in variety of roles as a product manager, I would say, and experience in launching products in many, many geographies. And since your career started with, building businesses and launching them, what were the reasons? Why were you passionate about entrepreneurship, and why are you still passionate about that?
Well, the cool thing is when you're working in startups, you can really have a direct impact on what is happening. So you turn some wheel, you pull some certain lever, and something will happen. And usually this happens rather sooner than later, meaning you have a direct and really short feedback loop. And especially when you're young, that really helps to understand that you can have an impact, and that impact is really immediate. At the same time, you also don't need to spend much time on politics, on political discussions, meeting, overhead, and all of that, because a startup is usually small, it's lean, and all of the people you're working together, they want to get things done. And this really helps you also to learn a lot and absorb a lot of knowledge. That goes also together that if you can perform on the job over time, that you get a lot of responsibilities over a short period of time, again, contributing a lot to learnings. I would also add that the people you're working with, they're usually often, actually always very open-minded, otherwise they wouldn't choose the same path as you did, obviously. They're international, it's a very international system. I mean, English is the normal, even though you're living in Germany, France, or wherever, everyone is speaking English. And it's always fun to interact with all these people. There is, of course, also downsides. When I joined the startup world in 2011 or 2010, there was a lot of like setbacks. So for example, I had to let go a significant portion of my salary. Today, it looks a little bit different because the startup systems around the globe have evolved. So there's not this big step you have to take back, but nevertheless, financially, it may still be more attractive to go in corporations, consulting, investment banking, whatever the alternative is. And that again correlates with what is the perfect starting point for everyone to get into startups. Meaning when you're younger, you can live on a lower salary and wage. Once you grow up, you find a significant other, maybe your own property, maybe you have a family, like a kid and a dog, like whatever it might be, it becomes a lot harder to do this setback, to take a step back in terms of compensation. So yeah, for me personally, I don't regret it. It was a perfect move back in 2011.
Amazing. So guys, those of you who've joined, please feel free to ask questions in the chat, and I'll keep taking that in till the time I'll keep chatting up with Tim. So your journey has taken you almost to the other end of the world, down under, and now you've returned home to start Rock. And if it is often said that Silicon Valley in New York or other hotspots in the US are great places to start a tech company, is there anything that you think for a young German mind that they should know about establishing a business here, especially since you're German and you came back here? And maybe it's relevant for other geographies in the world as well. What made you to come back, and more specifically for the locations that are not hotspots? even in Germany, like I'm living in Cologne, and despite being a big region, Cologne, Düsseldorf, Bonn, and NRW being the most populous state of Germany, we are still not a hotspot. So what do you have to say about that?
Well, actually, there is, I think, I would say there's 4 different hotspots for startups in Germany. I mean, in the north is obviously Hamburg, in the west it's Cologne, in the south it's Munich, and in the eastern part of Germany it's Berlin. So basically, it's pretty nicely spread across the country. So having said that, I mean, obviously, different countries have different advantages. So, for example, as I said, I lived in Australia for quite some time, and I really enjoyed the time there. I mean, people are also open-minded. It's very fun city, like Sydney is a fun city to live in. It has a high value of living, makes perfect sense. Silicon Valley, which you just mentioned earlier, of course, has a strong ecosystem. So you can talk to like-minded people. Also, Germany has advantages. I think by definition, it's one of the biggest markets and significant economies in Europe still. So if you are building something which needs physical presence, like sales, you need to go visit customers and so on and so forth, it's still sufficiently big to build a significant business. And it's actually a good landing spot. So you can also expand to other geographies in Europe, or maybe even across the ocean to either Asia or the States. What I particularly like about Germany is actually you have great talent. So the education is very good. You have a very robust social security systems, which I personally value a lot. So there's stability around it. For example, health insurance is, I mean, not specifically Germany, but in Europe as a whole, is probably the best in the world. What I also find really good, especially in Berlin, like I don't know about other cities, but in Berlin, for example, we also have relocations of people, developers or VPE came from India, for example. We have others from Ukraine and other geographies. And the immigration office is super helpful. Processes, yes, it takes a little bit of time, but that's normal. We cannot expect processes to just take a day or two. It's still a matter of days, but everyone is helpful and it still works. And it also has, which is for us a given, is very, very strong legal system, which when building up a startup is also so very important, because if you're writing a bill and people don't pay it and you have no legal means to enforce it being paid, I mean, that will be a nightmare. And I mean, given that we are living in Germany, Europe, States, and Australia, that's a normal. We don't expect that. But in other geographies also where we launch ventures, that is not the case. So we always have to be aware of that. There's also like way more anecdotes about parcels being sent in Africa to streets and persons who don't have a street name or house number. I mean, all these things is basically a given, and that's something I'm grateful about. For especially Berlin in this regard, I chose Berlin to be my hometown. Still has the advantage of having a big ecosystem, and I can talk to like-minded people. Even tonight, I have another get-together of founders here in Berlin, and it's, I mean, your day has 24 hours, and if you want to leverage these 24 hours to meet people, you could well do that. I don't want to say that that probably if you talk to people in Silicon Valley and San Francisco or the East Coast, you would have different perspectives for sure. But I also value Berlin and the opportunity to be here.
Amazing. So we've seen people raising millions of dollars on a pitch deck from private markets. And do people need networks in order to be successful to raise money? Or what qualities does it take for a founder to be able to convince investors to invest with just a pitch and very early in the process?
So, I mean, you have to imagine if you're a self-burn investor, whom would you give money to? I mean, you would always give money to those persons where you have the confidence that they will deliver something exceptional, like really exceptional. Because VC is an outlier game. The VC funds basically have a few selected hits in their portfolio, which are outperforming and basically paying the rest of the companies who have not been successful. So it's really an outlier business. And the VC is looking for those outliers, and they're looking for really exceptional founders and exceptional business models where they have the possibility that they will be these fund returners. So the question is now, what can these proof be? The proof can be previous performance. So you have been exceptionally great. Maybe you have been a unicorn founder. I have not been that fortunate. You can be unicorn founder, and then it's very likely that one of the big brands will basically give you money, because that is a very, very high proof that you are able to perform and outperform once more. You can have specific knowledge about something. So maybe you are an expert in a certain type of robotics, and you are the only one around the globe who has a certain set of knowledge and who can execute that and build something on top of that knowledge. That might also be an indicator for that. Maybe you already have an existing product, maybe bootstrap, maybe through previous funding rounds, it's seeing great tractions, the numbers look good. That could also be proof. The thing is always you need to convey that you really can deliver something great, and whatever you can do to do that is basically helping investors to give money to you.
Yeah, so it's delivery, expertise, having the right skills on the team, and be able to, have good enough network to be able to showcase your talent to that network so that you can convince them, and bootstrap. Have some savings and bootstrap, build the product, show the MVP. Great.
Yeah.
So if the founders did not have enough challenge to roll out products, continue the product market fit, get the revenues, and today we are facing recession and inflation, etc. So there are more challenges that have been added to that list. What can founders do to tackle the current challenges that we are in and still come out strong on the other end?
Well, the most important learning is that, or the most important thing is always that you need to be super conservative. Like, don't expect funding anytime soon, because the market, I mean, we can discuss that at a later point, but my personal opinion is that we are not yet in the downturn, but we are on the way of the downturn. So we are not yet at the deepest point. And I think it will take a couple of more, probably years even, until we see a recovery. We will probably never recover to the previous state in 2021, like at high valuations, everyone was getting money, money was everywhere, and it was super easy to get it. So we will come to a recovery over the course of the next years, but it will take a significant amount of time, and nobody knows yet if this will be 2024, 2025, or 26. So stretching the runway as far as you can and be super careful with your spendings and whatever you do. That is probably the best piece of advice you can give now. If you want to build, like if you are now in a position where you need to switch jobs because your company is not doing, like the company you're working with is currently not doing great, this actually may be a great opportunity to build something, because you have lower opportunity costs than you would have in a market upturn.
Yeah, great piece of advice there. So what's your take on startup due diligence from a very early stage companies to companies that have achieved the product market fit and now are generating revenues maybe in excess of 1 million as an ARR? What should they bear in mind for both financial as well as technical due diligence?
Well, in the technical due diligence, that was basically something which I did at GFC, like Global Founders Capital. That is the 2 billion euro investment fund under Rocket Internet. And I was doing a lot of technical due diligences for the portfolio companies, but also previously actually for private equities. There's a couple of things where investors look for. So the first one is, how well is the alignment between what you are doing as a business and your technology? So you should always have pragmatic solutions, not over complex solutions. There is one tendency, just as an example, for a couple of years, everyone is building microservice architectures. They have advantages, but these advantages usually kick in when you have a team of 20, 30, 40, 50 developers. Until that point, it's causing a lot of additional work and effort, both for building it, but also for maintaining it. And thereby, for example, if you're now running a team of 3, 4, 5 developers and you have a super complex architecture, then there is possibly a misfit between your technology stack, the state of your company, and the ambitions which you have over the course of the next years and months. So having alignment between the complexity of what you're building and how you set up your technology stack to what you are doing, that is a very important point. There's a second point which I want to highlight for technology due diligence, which is IP ownership. So of course, can expect if you're running latest in a Series A round, usually also earlier in a seed round, your investor will look at your tech licenses. And there is one thing which most business founders especially are not aware of. You have licenses. So basically when you're building up a tech, like a tech product, you're using a lot of different software. So if you're building an e-commerce shop, you may use, for example, Magento. But also on a smaller scale, if your developers are looking for solving a certain problem, they might look at GitHub and get a certain library which is like solving a part of the problem. And via a dependency, they will basically take this piece of code into your own code base, and this code base will be deployed on your servers and like giving value to your customers at the end. So there's two different scenarios. This little bit of piece of code which you're pulling in from GitHub, this always comes with a license. And there are open source, like it's open source because it's available on GitHub. Everyone can download it and use it. And there's two different cases or scenarios of licenses. There's permissive open source licenses like MIT AGPL. So you can use it and you can build on it and no harm done, everything is fine. There is also licenses which have something like, it's called copyleft. And a copyleft license is a naughty thing because it's in the license text, it's basically saying, well, you can use this piece of code however you would like, under the condition that whatever you build on top of that or whatever you build around it, you also need to make available with the same license. So it's basically asking you to publish your own code base. But you are now a startup which is spending a lot of time, money, and effort into building some tech stack. And now you have like a tiny piece of code which is basically infecting your own code base and making you legally requires you to make your code base public. Well, reality is nobody will see it, but from a legal point of view, this is super, super dangerous. And this is something which comes up actually quite frequently because most startups, especially when you're young, you want to build something, you don't put the time and effort into a license checkup. There's tools out there which facilitate it right now because also the problem has been more people have become aware of that, but still it comes up quite frequently. Financially, well, I mean, there's two different views. I mean, basically, of course, you need to have a business plan, and that should be should make sense. Like the further you are along the journey, the more accurate it should be. There will be cohorts on how your different customers are doing, and so on and so forth. What do I mean with two different views? Especially if you're a young startup, you need a business plan to prove that there is a viable business behind it. But everyone is also at the same time aware that that will not be the reality. Things will look 100% different a couple of months, maybe even weeks down the road. So financially, of course, you always need to be able to prove what you're building makes financially sense. It's scalable. It has a great foundation. But things are moving, especially there, rather quickly. And that's different to tech, because usually with tech, you have a dependency, you're building that over time, and you're not in a position to fully re-platform your whole tech stack over the course of days and weeks.
Yeah. And in DueDash, we have like 5T model, which is team, timing, traction, technology, and TAM, market opportunity. So these are some of the dimensions where we ask founders to share information on, and they are the core fundamentals on which investors assess predominantly. So I think we covered fundamentals here, and I think that gives a great insight to founders how they can tackle the information that they need to share with investors, and also help them in actually getting their business model sorted, having their business model canvas prepared, and keep on refining on that financial projections, which continuously change with the product market fit and getting the right persona while developing still your product. So investors often say no to founders, and for many, fundraising is a long and a tedious process. So what are some of your thoughts that you can share how founders can turn rejection into opportunity to actually build those relations with those investors who they have engaged with, whether they are angels or funds?
So first, fundamentally, it's a very great scenario because you have investors who are willing to spend money, and you have startups who are basically looking for money. So you want to make that matchmaking, so to say. Beyond that, what I said earlier, I think when you're talking to investors and getting a no, that's a normal thing. I mean, usually it's the normal that you're talking to, say, 100 investors, you get in very close contact with maybe 10, 15, depending upon the business model and the market, maybe 10, 20 of them. And in the end, basically 1 or 2 will invest. Maybe it may not even be 100, but maybe 200, 300, 400, 500. So the normal is, unfortunately, just by the numbers, to get a rejection. So that is not a bad thing. That's part of the normal. The question is, what do you learn by each rejection? Because there is motives behind it. So it's always super essential to understand the real motives. Because there's a lot of, like, investors may say you're missing traction or this or that, but usually it's something more fundamental. Like they found very concrete things which they like or didn't liked and didn't like. And to explore these reasons is super, super essential and important for you to improve your own offering and to improve the talks to the next investors. Second, you should also be aware it's a funnel. It's a sales funnel after all. So basically, you should run it, maybe even use a CRM like Pipedrive or something like HubSpot is probably too big, but like small Pipedrive, they keep track of whom did you talk to, at what time, what was the feedback, which pitch deck did you share, did you do the follow-ups on day 1, thank you for the call, day 7, hey, did you have a time to chat, to think about it, maybe after 2 weeks, hey, did you discuss it in the partner meeting, and so on and so forth, basically that you have a, like also a click kind of, or an email kind of journey with them. And then the next, like basically manage that as a process, like as a proper sales process, the same way, like how you manage enterprise sales, like a target in enterprise sales, the same way you should also manage investors internally. The next one, number 3, super important, be a line, not a dot. Like you don't want to have like this once in a lifetime thing where you talk to investor, put everything on the table, and then you expect a yes and a no. That's usually not how it happens, but you want to be, you want to talk to investors, maybe get to know them a little bit, but don't be too concrete, just talk to them. They should become aware of you're basically fulfilling what, like basically show them that you are fulfilling what you're telling them. So if you're telling them in January, hey, we are currently in the go-to-market, we plan to go to these conferences, do this and this and that. And then basically 6 months later, you're talking again, do a little recap, what happened in the past months. Yeah, we had this conference and so on and so forth. Make it a journey. But now, and this seems at first contradicting, because the first recommendation I would have is that you want one point in time where you know you're raising a round, and then you want to run a process and also talk to investors in a different manner. Because basically in over a short period of time, you want to figure out who is willing to invest in myself, what are the terms, who is in, who is out, where do I go further? And you need this condensed kind of period of fundraising to also create this FOMO momentum, because like we know investors are talking to one another. They're running a super close network. And you basically don't want to be on the market fundraising for extended period of time, because if you're talking in November to one investor and he has already learned that you talked to some other investor in August and you didn't find a deal, the first indication is, well, they're looking for money for 4 months, something is wrong there, and you want to avoid that impression. So you want to build a relationship, but at the point in time where you fundraise, you really want to condense it, and you want to run as like a very, very streamlined process. If you want to learn more about that, there's also a podcast by Florian Heidemann about that, which is super good about fundraising. It's 1 hour or so. Just listen to that one. He can explain that in way more detail as I ever could, also because his knowledge in that area is like, yeah, more than 10-fold higher than mine.
Sure. Thank you so much. But Tim, do you know, with DueDash, startup founders can create a structured company profile and have a secure data room. I think you're doing that as well.
Yeah.
And share their one-pager pitch deck, and right from there, and if it is a good fit, they can build investor engagement. So we have messaging functionality, a simplified one. And in addition, startups can also share their monthly and quarterly investor updates from the platform right away. Yeah. And as a result, there is a complete investor relations ecosystem in a single system. And on the other side, investors can use the system for all the aspects of deal flow through due diligence and portfolio management and tracking, including the showcase.
That's actually
So
super
guys,
important. I mean, just to comment on that,
yeah,
if you're raising your round and you're sharing Google Docs and
yeah.
Google Drive links, then you're probably doing something wrong.
Yeah.
You want to professionalize it. So it's perfect.
Absolutely.
It's exactly what you're saying now. You need to run a streamlined, extremely professional process and use all the tools available to do that. Yeah.
Yeah.
A data room is a must-have.
Absolutely. So we've streamlined that engagement because there are like massive workflows, and the simplicity in the workflow is what DueDash brings with the software, and the diligence piece being in the middle on one side, creating the traction for the investors before the investment decision can take place. So you build that, and on the other side, once that decision is made, then the flow of information as you enter their portfolio so that they can come on in the following rounds, or they can make the introduction. So that's how DueDash is basically built. And all the startups can get access and get a free fundraising profile, and investors can simply register and access deal flow. We have a deal flow over 1.2 billion at the moment on the platform, which is verified, and perform the due diligence and track their portfolio. I just have a quick question. If you could please mention that podcast once again, because we'll put a link to that as well, Tim.
Yeah, that's Florian Heidemann. It's, I think, on Digital Compact with Joel. I would need to check the exact title, actually. I don't have it on top of my mind.
No
but
problem.
It really is a brilliant podcast, and I recommended it several times, probably not per week, but per month.
Yeah. Sure.
Yeah, you will find it with fundraising with Florian Heinemann, I think is the name.
Okay, great. Thank you. So there are a couple of more questions that are coming through from the audiences, and I think it's a great time to pick those up. Mm-hmm. So one of the questions is that why do investors tend to avoid solo founder startups, solopreneurs, basically?
I mean, there is pros and cons. So Hanno Renner, the Personio, for example, is a solo founder. It's only one person who built that up, as far as I know, or at least one prominent person. Usually, I believe, the more bandwidth you have in the founder team, the more you can deliver. And I think that is part of the reason. Another reason may be, it always depends on the use case. Another reason may be that it's about risk. So because if it's, you could call it bus or truck factor, but if one founder is not willing to build the business any further, the company would be more or less dead, or at least be in have significant problems. And thereby you mitigate that risk with more founders. You could rephrase the question to what is a healthy founding team size? And probably it's somewhere in the area 2, 3, 4, or 5. I wouldn't go much higher. More important is actually that you need usually if there's a conflict, you need one person who's making the call on how to talk to investors, how to make a certain decision, and so on and so forth. Also, investors they want to have one person responsible among the founding team. And that is basically, I think, the more important argument, that you, there is not this, yeah, exactly.
Yeah. So I have a question on this, because you mentioned you have a company now with 2 CTOs, though you have taken the business role. So how do you resolve the differences if you have a difference with your CTO now?
I think it basically is per domain. So if it's go-to-market, marketing, business ops, then it will be me. If it's deep technical, it will be Fabian. There's a very clear cut on that. There is one difference between Fabian and me, I would say, compared to usual founders, because we've been working together in a professional relationship for 5, 6, 7, 8 years, and along the journey also became friends. So not super close best friends, so to say, but super strong professional relationship, but a healthy friendship where we also meet in private, both families and so on and so forth. And I think that is a perfect foundation on building a viable business.
Amazing. So there is another question that is, what was the most frequent due diligence issue that has been seen by investors before they decided they're going to abandon the term sheet offer?
like a red flag in terms of
Yeah,
tech?
red flag. Maybe they gave an offer, or they were thinking of giving an offer, but something which they saw most frequently that happened to abandon that process.
Well, usually, like as I said, like the license check comes up quite frequently. And the second thing I think I mentioned also, that is a misfit between complexity and how the software is built to their business. So if you have a very straightforward business, like a transactional, like, I don't know, like a standard e-commerce shop, and you would basically run a 20, 30, 50 man woman development team, whilst it could also run on Shopify. These would be the usual things where you have a misfit between requirements and how it actually looks like.
Okay. Okay, there is a personal question here. Why did Tim move away from capital deployment to get back into the trenches of building a startup?
For me, it's more fun. It's more fun to basically build things, and it's more fun to basically build something permanent and resolving problems along the journey. I mean, we all know it's not going smooth, but you figure out, hey, how is this message going in marketing? It's not going good, turn out something else, but it's a continuous journey and building up something and taking all of these setbacks, so to say. It makes, for me, life, it's more fulfilling.
Having fun along the journey, getting more challenges in the journey as well. That looks like your Kool-Aid.
But it was fun. It was fun. Like the first year in my career, I was actually working corporate. I don't want to miss that. Then I was working in small startups. I don't want to miss that. It was literally, yeah, it was a good journey. Also seeing VC, seeing like how VC is basically making the decisions. What is the role of an LP and GP? How basically the funds are committed and all. Just to understand the economy, the economics. It's super interesting. If we have time, we could also dig more into the recession and the implications, if you like.
Yeah, sure. Happy to. I'll just take one more tech question and we can just dive deeper into the recession aspect. So there is a question, I think it popped up when you were talking about the codes and MIT licenses versus the other licenses. So why don't we just shun such codex databases, and as it is really unfair to the little companies? I think that was a remark from one of the founders here.
So the question is, why is there no database, or
why don't we just shun such codex databases, as it is really unfair to the little companies, because maybe it's a lack of knowledge or they don't know enough. So they build on that. So why not just not have them in the first place? I think that is what he was trying to say.
Well, I mean, basically there is tools available in the market to mitigate it, to mitigate the issues which you're having, but the core thing is you're not aware of it. If you're building a significant tech venture, well, let me put it different. If you're a business founder, you rely heavily on the tech knowledge of your tech counterparts, be it a co-founder or be it a VPE or be it a director of engineering, maybe a first engineer. And especially in the first part, you're not aware that there is maybe an issue. When you grow, you need to professionalize, not only in tech, but also in other areas. And part of this professionalization is that you have more senior talent who is aware of such things, and also like mitigating those along the software development life cycle. As I said, by now there is tools and databases available which help you to mitigate the risk and to basically evaluate all the different licenses. The challenge is that at first it's a super complex topic, because you yourself are using one library. This library, again, is using 10 other libraries. It's basically a tree structure. And all these dependencies multiply out to a huge amount of software pieces, like little pieces of information. And it's not something which you could do it with manpower yourself, but it's literally a lot of work. So therefore, it's really cool that there are now solutions handling that for you, which again, you need to pay a couple of €100 per month just to have that issue resolved.
Okay. So there was a remark, I think, based on what we were speaking earlier on. So it's a virtual hotspot now. So networks like DueDash or LinkedIn groups, etc. And teams and investments are becoming global and distributed today. What's your take on it? And what would you say? What would be the right networks to get into virtually? Yeah,
there is, I mean, that's part, like the question, Taylor, goes towards the Corona phenomena, right? Everyone is in home office right now. People are working more remotely. There's less face-to-face interactions. Also, we have the same phenomena, even though developers are physically just a kilometer away from me, I don't meet them in person for several, not months, but days or weeks. Actually, we had a company meeting where developers have not been to the office for almost a year, like of the company we talked to. And the question is now, can we also replicate learning sessions in a virtual instance? And my take is, no, we cannot. I think we still, if you're meeting new persons, meeting them face to face, if you are at a conference, just walking to a random group of strangers, like, hey, what are you up to? What are you discussing? Who are you? What are your challenges at this point? You cannot replicate that in a virtual setup. I think it's great to have LinkedIn groups. I personally like Hacker News, for example, the forum Hacker News a lot. Also Reddit to some degree, but it doesn't really help you to replicate this kind of meeting people in a setting which is kind of curated. You cannot, like, it doesn't replicate to the digital world. There's too much noise. Also LinkedIn groups, there's too much noise, and you cannot really connect to people in a way that you could meet them maybe a couple of weeks later or write them an email a couple of weeks later and they could relate to you and your questions. This is something which you can only have in for example, meetups and in get-togethers with fellow founders, or whatever the scenario may be.
Yeah, I think it makes sense to kind of meet the right kind of people. Then it's quality versus quantity kind of a decision, and also build relationships, because that's what you can do if you meet people in person or in curated groups, and those could be more meaningful than just knowing somebody. So that definitely resonates with me. So let's dive deeper into the whole, recession and the whole scenario that we are in with inflation, rising interest rates. I mean, we know VCs have raised tons of money, but they're not deploying it. So what is it that they're waiting for, despite the fact there's so much dry powder out there?
That's
startups are not getting money. So what is your take on that?
That's a super interesting question, because there's a very binary opinion. So the VC funds have collected huge amounts of money, like more money likely than ever before. You call it dry powder. So it's money which is committed by LPs, ready to be invested by VC funds around the globe. And now, like, I always come across two different theories. The first one is the VCs have to spend it. They have to give the money somewhere because they have it committed by the LPs, and the LPs expect them to give it to startups. The contrary opinion is exactly on the opposite. Well, the VCs don't need to call the money from the LPs, meaning an LP is giving money to the VC, and the VC can then invest it. But the VCs can also decide to not invest it. And especially, there's now two scenarios which are often highlighted. I'm not a VC, I'm not an LP neither. So basically, there's now the two scenarios why a VC may not invest. The first one is that an LP, like a person who's contributing money to the VC, is approaching the VC partner board and saying, hey, if you don't spend all the money, that's super okay for us. Actually, we would really like you to not do that. It's just usually it's on a like just per voice, because usually you have contracts and there's like dozens or maybe hundreds of LPs in there, and you do not restructure all the contract because someone is saying it. But if one of the most important LPs is telling you don't invest all the money, that may have an impact. The second one, the general partners of a fund or everyone basically who has a carry can also say, we are not calling any further money because we already have a portfolio. The portfolio is going great. It's outperforming. We have existing companies. If we now invest further in an economic downturn, we would risk the we'd already risk the returns which we already realized, or the returns which are basically on paper now. And thereby a VC fund in themselves may also decide to not invest any further. And these are the two different opinions, like either like, hey, there's money, they have to spend it, or there's also like they have the commitments, but they're unlikely to spend it. And which ones is true? Well, we probably will only know in a couple of years down the road. There's also long Twitter discussions actually on that one, which are super interesting, but it's always, I think, very, very binary.
Yeah. So actually, I did some analysis for some of the big funds. So most of the funds who received money are GPs with some credibility track record. So they've been able to raise a lot of money.
Mhm.
So it's back to the GPs who have massive successes behind them. The second part is the GPs who raised a lot of money are the ones who have committed more than what they did in the past. So that's where at some point they're also saving their own skin in the game, and that's why they're not deploying. And then it kind of adds to the dimensions of what you said, maintaining their own relationships with their LPs, because the market, if it is going to go down, then they don't want to risk the capital, how it's going to get deployed. And also on the other side, LPs are saying, if you don't, it's fine for us because it's commitment. And when the callings are going to be made, then maybe they would not be able to fulfill it. And of course, focusing on the portfolio will be much better for the longer term to focus on that to get a better return. And then it's also adding into their own, for future of further fundraising.
There's a very famous quote which comes like repeatedly, which is VC is a multi-round game. Because a fund always needs to raise the next fund, needs to raise the next fund, and so on and so forth. And that is actually also how it's true for founders. Like for founders, it's also a multi-round game, because it's very unlikely that in the span of your professional career, if you like working in startups, that you will only found a single venture. Usually you will build multiple, or at least try to build multiple. And therefore it's also super important to always have healthy relationships, not only with the VCs which invested in you, but also these VCs where you didn't find a deal with.
Yeah, absolutely.
And just one last thing about the economy. I think there is the perception in the market still that the crisis is already done and over and basically everything will recover. My personal perception and interpretation is rather that we are just still on the way to the downturn, which you could see for the differences in how the tech stock market is reacting compared to how the normal stock market is reacting. So if you look, for example, at Shopify, they are at like minus, and I'm not sure, I think it's more than 70%. On a higher level at the NASDAQ, you can also see that they are somewhere from the heights minus 30, 35% in that area, while the DAX and Dow Jones, they are somewhere 10 to 20% minus. So the downturn which we could see in tech and startups, it did not really arrive in the normal mainstream economy, so to say. But I think it will actually spill over there due to higher gas prices, lower output, higher cost of productions, inflation, higher interest rates, and so on and so forth. So my personal what I personally believe is that we will probably have a downturn of another 12, 25, 24, maybe 36 months. And yeah, again, re-emphasizing on be super careful with the cash that you have on hand. And if you want to raise funds, maybe even now is a better opportunity than a couple of months down the road.
Yeah. So I'll ask you some very quick questions now, and you need to answer them very quickly with 1 or 2 sentences. Let me know if you're ready.
Okay. Yeah, go ahead.
Yeah. So pitching is super important. And what would be like a great pitch to an investor, which you have to give in 60 seconds, which includes your introduction and what you do? Can you give us an example?
For myself, you mean?
Yeah, I mean, any example that comes to your mind. Either it's Rock, which is a great pitch, or something about.
Okay, I'm super not in pitch mode at this point, but let me try. So basically, I'm Tim. I'm an experienced tech founder. I've built several tech ventures in my past. I've learned that whenever you build a web application, SaaS application, you spend a lot of time and work into building commodities which are not contributing directly to your business. We at Rock help you to deliver these commodities in no time, build a significant SaaS application, and really focus on what matters.
Awesome. So how do you think Rock will impact the startup ecosystem, and what is your long-term impact that you're thinking to create through Rock?
That actually goes towards our vision. Like, we want to make web app development faster, better than ever before. And we want developers to really program and write code which give value to their specific business and save them of doing commodity work.
Who is your childhood inspiration?
Oh, that's a good one. That's a good one. From today's point of view, I would actually say my father, because there's a couple of things which I learned from my father, which are truly great. The first one, there's a German saying, everyone who's cooking noodles is cooking it with water. So basically, everyone is equal. So you need to treat people with respect, but you should not be afraid and have fear because someone has overperformed or something in the past. You can always, if you're on a conference and you want to talk to someone, you can go there, and chances are that they're very open-minded. They want to talk to you and discuss with you. Chances for that are super, super high. The second thing he taught me is that just doing things. So don't be afraid of any challenge that is in front of you. Just get started and solve it. And that is true that holds true for both in startups and what we're doing from day to day in our company. Just get on the phone, call someone whenever you see a problem, but also in private life, very pragmatic. If, I don't know, something in your flat or house is falling apart, just take a screw and a nail and fix it.
Be very pragmatic and practical and never shy away from the work at hand. That's amazing advice. But I think I just digress, and I am really curious now to ask you if you can tell me what, I mean, I've not seen many, the culture of entrepreneurship in Germany, so to speak. So where do you think was a difference in your upbringing or your environment, which kind of inspired you to become an entrepreneur?
It doesn't I cannot pinpoint a single person. I mean, literally, how did I get into startups? It was, I was working in a remote city called Gütersloh, where I had a super challenging job, and it was super fun, like doing M&As for the direct management board and so on and so forth. It was a super cool job. But then really literally at a party of a friend, at a birthday party, I was in Berlin. And at this birthday party, everyone was working in startups and super exciting. Yeah, I'm building this and this gaming company here. And another one was, yeah, I'm building this online dating app here. And just getting into this melting pot and talking to people, building something from zero to launch and beyond. That was literally very infectious. Like really, it got me interested. And this was really like this. It was literally one evening. It was one evening because literally at this point you could talk to anyone. What everyone was doing there was super excited, and I was just like, okay, and why am I doing this other thing? Which was still very good, but in perspective, it was like I'm there like doing something really small, incremental, and everyone else was doing like the big whole thing, and that was really this aha moment. Yeah.
Reminds me of the Code, the Netflix series right now. So, but anyways, that's what
I haven't seen that to be fair.
It's very
possibly
good.
I should, but I'm lacking time.
Yeah, it's really good. You should. So, what qualities do you value most in a professional relationship?
Authenticity, honesty, and also as a German, I like really people who are straight out. If people don't like something, please tell me. It might be partially offensive also to me, but I really want to know that. Yeah.
Okay. So what drives you when you get up in the morning?
What drives me in the morning? Checking off the next items from my to-do list, which are just basically rearranged and reprioritized as the last thing before I went to bed.
Okay. And do you read? Are you currently reading something? Would you like to share?
I read a lot of books, like 0 to 1 and all these. And I always find it very challenging because you have like 200 pages about a message which is rather condensed. But what I really like actually in this regard is Blinkist. And if I find something which really is super curious, then I dig deeper and read the whole book. Well, in truth, is not the whole book, but at least those parts which I find interesting. Like in my job, I come across very diverse challenges from day to day. Like today it was message market fit was something I came across, and basically the best resource really still out there is all those forums, be it Hacker News, be it Reddit, be it Google, whatever you find there, because there's so much knowledge available out there right now. And the skill is rather to figure out where do you find the best piece of information, what to ignore. And basically this is more my reading of the usual day.
Okay, great. Thank you, Tim. I think one last question before we close out here would be to build, like, SaaS companies are still like one of the most successful business model out there to scale a tech business. So other than having a good CTO, what are the other key components for building a SaaS company that a team should have?
But more important than having a CTO is likely to find product market fit.
Mm-hmm.
Because there's also the exception where you could use a no-code tool to build something valuable without a CTO. But then if you have a great product market fit, you can still build a great, big, also financially successful company. The best example of product market fit is always Calendly, which is a tiny, tiny tool, but it's super, super successful. So yeah, I think sorry, I lost.
So what I wanted was the skills. So I feel the SaaS sales is something which is not often said. I mean, we do talk about the product market fit, knowing your customer and ICP quite a lot. But I think one of the skills which is not often spoken about is how to market a SaaS company and how to build a sales engine and a replicable model, because that's the whole beauty of it, that it should be able to scale. Yeah. So how do you assess that skill in a team player, whether they have those marketing and the sales skills? Maybe if you can highlight that would be great.
Well, initially, I mean, before you are a big successful companies, you have to find product market fit, as you said. And along the journey, you, or at least a few selected persons, ideally the founders, need to make sales or do sales themselves. And basically the most important thing is that you do not just collect data points. Like, for example, I talked to this customer and this core was good and that core was not good, but really getting all the data in a structure. Can just be Excel, doesn't need to be Pipedrive or HubSpot, just in an Excel. Whom did you talk to? What was basically the outcome? Few characteristics of the person you talked to, the hierarchy level, just one really big Excel. And then you have the data in front of you. And with that, you can create pivots, you can filter it, you can drill it here and there. And this really then helps you to generate information and knowledge out of that. And I think when building a SaaS startup, that's probably the most important thing. And it goes hand in hand with what are you building with technology and what is your offering, because the offering is defined by tech usually. And thereby you can fine tune the product, come to product market fit, and then come to a more scalable process where you also recruit people, maybe a SDR, sales development representative, maybe an account executive, something like that, because then you have generated the playbook on how you can sell whatever you build to the market. And I think actually that's the most critical part, like this little, and literally can just be this Excel sheet, which really tracks down every single call you had and tracks down what went good, what did not get good. And most importantly, of each individual you talk to, what was her or his concern. Because that's usually more valuable feedback than, hey, everything great, but I can't buy it at this stage because whatever.
Yeah. Yeah. Okay, so how do you recharge yourself to keep pressing on with your company?
How do I, sorry, pardon me?
How do you recharge yourself?
Oh, with my family, very straightforward. I have a 2-year-old boy, Oscar. He's great. It's so much fun to play with him, to bring him to Kita in the morning. Yeah. Whenever I find the time to also pick him up from there, that's really recharging. Yeah, that really helps. Like, kids really help to see the world from a different perspective. That really helps. A couple of years back, I would have said sport, but in fact, sport with startup and family, it's very hard to achieve that. What I would add here is I like home improvements and woodworking. But honestly, also since Oscar is here, I enjoy spending time with him more than that.
Probably building Playmobil with him would be more more of the home improvement task.
Actually, he has a little chair we can change the level of him, and we just fixed that last night together, and he actually drilled the screws, and like he took a screwdriver and could do it himself. Very
good. So Tim, it's been fun talking to you. And if you were to give one piece of advice to young Tim, what would that advice be?
Oh, that's a brilliant question. I always ask that question in interviews. That's brilliant. It's a lot about before getting, like, whenever you start your new job, it's extremely important to build relationships, but it's also important to build your own tool chain. So basically figure out what works for yourself in terms of organizing your work, be it to-do lists, be it like in the evening, sitting down, recapturing your day, because it's very individual. But building relationships is super important, but also super important beyond factual knowledge is building or finding a process for yourself to organize how you work in order to be more efficient and get your work done.
Awesome. It's been amazing talking to you. Thank you for taking the time and sharing your insights with our audience here today. I'm sure they found it valuable. And thank you everybody for joining us from different parts of the world. Wherever you are, stay safe and stay happy. And keep building with the rigor that we just discussed. So being in a startup is a sport, so keep continuing with this.
And when there are subsequent questions, feel free to write me also on LinkedIn, find me there. Thank you very much for having me tonight. It was a great talk. It was a pleasure.
You. Pleasure is mine. Thank you. Thank you, everybody.
Thank you all.
Thanks for
Bye-bye.
joining. Bye-bye. Bye now.